This is MacroVoices, the free weekly financial podcast targeting professional finance, high net worth individuals, family offices, and other sophisticated investors. MacroVoices is all about the brightest minds in the world of finance and macroeconomics telling it like it is, bullish or bearish, no holds barred. Now, here are your hosts, Eric Townsend and Patrick Ceresna.
Eric, it was great to have Rory back on the show. Now let's get to that chart deck. Listeners, you're going to find the download link for the post-game chart deck in your Research Roundup email. If you don't have a Research Roundup email, that means you have not yet registered at macrovoices.com. Just go to our homepage, macrovoices.com, and click on the red button over Rory's picture saying, looking for the downloads. Now, Eric, let's start with the equities. What are you thinking here?
The big story this week was obviously DeepSeek. Now, for anyone who hasn't followed the news, here's a quick summary. Until this past weekend, 3 beliefs were assumed to be immutable fact by almost everyone in the world of AI. Number 1, the AI race is all about spending money on model training, and whoever spends the most wins. It was assumed that little could be done to reduce the cost of model training, and for this reason, only the biggest of the big tech boys could play in the AI model training sandbox, because nobody else could afford to play the game. Number 2, the only way that anyone could possibly even hope to compete was to have the very latest NVIDIA GPUs, and a whole lot of them. Now, since these are export controlled, it was assumed that China didn't even have access to the tools needed in order to be in the fight, never mind to win the battle. Number 3, only the very cream of the Silicon Valley crop was smart enough to play this game. So anyone else overseas, like those dummies in China, well, surely they could never hope to compete with American technology exceptionalism. Then China shattered all 3 of those presumed immutable facts with the weekend release of DeepSeek, an AI that basically does the same thing as ChatGPT, but which supposedly only cost $5 million to develop. The $5 million figure was subsequently debunked. It really cost more than that, but it's still clear that China did this at a much lower cost than anybody previously thought possible. The panic selling on Monday happened because everyone knew that NVIDIA led the Mag 7 rally on the way up, and they feared that a major blow to NVIDIA's earnings outlook could be the straw that breaks this bull market's back. But by the end of the day on Monday, the panic had subsided, and the retrace was already underway. As of Thursday morning, it looks like this is going to blow over, at least for now. But to my thinking, it still revealed the fragility of this market. And as I've said many times before, I think the real test of this market is more likely to be whether Trump's enemies score any big goals in undermining his policy agenda. Now, so far, all indications are that Trump and company are kicking ass and taking names in Washington. If that continues, I expect the rally to continue, at least for now.
Eric, looking at that S&P chart, we're stuck in a multi-day trade range after that reaction to the DeepSeek news. But we are at an interesting point on both the Russell and the equal weight index, which is both of them went through a very deep sell-off in December that was not evident in the main S&P index because the Mag 7s were holding up that index so strongly. But after such an oversold condition where the market breadth was so oversold, we've had over the last few weeks a big market rebound. And so we've had this retracement. But both the S&P equal weight and the Russell have done these 50% retracements of the prior decline, a level which, if this was simply a reactionary or reflexive oversold bounce, this is a level where these markets could easily roll over. Are they going to is the puzzle to solve here. The S&P 500 at the same time obviously double topped, retested its previous high, and then this news basically took the wind out of its sails. So we have a situation where we want to determine whether or not this becomes major overhead resistance, and we once again head back down to the lows established earlier this month. That's right now. We had obviously this pig in the python moment of news where we had Mag 7 earnings at the same time as the FOMC and the ECB as we're recording this. And so we have a market that has all sorts of triggers to potentially start movement. And so far, those triggers have not created more market volatility. And the question then becomes, what are the key technical levels to watch? For me, the 50-day moving average and key fib zones are in the 5950 to 6,000 level on the S&P. This is a line in the sand that the bulls must hold in order to keep the trend in their favor and leave the upside window open for them for continuation patterns. At the same time, the bulls, in order to really gain some traction on the upside, need the Mag 7 to all fire up with a breakout to an all-time new high in order to drive that continuation pattern that could see 63, 6,400 or higher on the S&P. We're at an incredible neutral zone area where the market is consolidating in this very tight range. The thing to watch is which way and who will it break out and who will prevail in that dominant trend. The bulls have command of the trend. Will they drop the ball and there be a turnover with a breakdown below 6,000 is the key thing to watch going into next week. So let's move on to the dollar. What are your thoughts here?
After taking a dive to test 107 on Monday, the Dixie is back to flirting with 108 again on Thursday morning. We've clearly moved into a consolidation pattern, but so far there's no compelling technical evidence of a new downtrend.
The way I look at the dollar is very simple. There's a very clear and pronounced bull trend and a bull breakout that happened here. And when you look at this US dollar rally that we've had relative to US dollar rallies we've had in the past, this is nothing in comparison to size and magnitude, which is that if this is a real US dollar rally, there's no reason why we shouldn't be going back to retest levels where we saw in 2022. At the same time, there's no evidence that the bears have regained control of this trend and somehow some big US dollar bear market is about to resume. Now, at some point, we will have a US dollar bear market. At some point, the bears will prevail. But is there any evidence or reason to believe that's now? And the answer for me is no. At this moment, there's been a pullback in the dollar, and the right thing to do in my mind is to assume that the bulls will prevail and still have another leg higher until this trend is broken. And right now, I think that the bull breakout on the dollar can still continue, and we could easily still see levels that approach those 2022 highs in the kind of 115 area on the upside. Now, Eric, let's talk about crude oil. What's your thoughts?
Since we recorded Rory's interview on Tuesday afternoon, the sell-off in crude has continued to test the 34-day moving average at $72 on WTI, and it's bouncing off of that level early Thursday morning.
Well, Eric, for me, this was the big test, right? We had a short squeeze on that crude oil. Everyone was short down along the low. Everyone was bearish as hell. And now we had this breakout that squeezed out all the shorts. And that a very typical kind of $10 to $12 short squeeze on the upside. And one of the things that I would have been very adamant about is that the breakout on a short squeeze like that isn't the tell. It's about whether bulls buy dips. And so here we now have fully retraced a good chunk of this short squeeze rally. And if the bulls are going to keep oil bullish, they're going to hold the line here, start some accumulation, and drive the trend back up. If literally this level around the $72 area is a must-hold line. If oil doesn't hold these lines, then it was just a short squeeze. And then oil will fall right back into the trade range that it was in the fourth quarter of last year. And then the bulls would have to start all over again, and then it would be just trade ranged oil markets. Very important inflection point on oil. Let's see whether the bulls can keep this going. All right, Eric, let's touch on gold.
A breakout to new all-time highs on the front-month futures contract, which is now the April contract, appears to have begun with the European Open on Thursday morning. But hang on, the contract roll from February to April accounted for a big piece of the upside. So it's still early to say that this is going to be a decisive upside breakout. A daily close over 28.25 on the April contract on Thursday would suggest that the rally will continue to test higher and higher new all-time highs.
Gold just remains so bullish. And what I mean by that is that every dip is bought. And this is the characteristic that you look for from a price action perspective. Every time gold has a down day, it gets immediately bid and it turns around and gets right back to the previous highs within days. There's very clear accumulation. It's approaching all those previous highs, if not already exceeding them on different contracts. And we're going to see whether the bulls can make this go. All the measured moves are up to 3,000 now. So if the bulls really can definitively break this out to a fresh high, this is the beginning of something very interesting. On a side note, silver just broke a very important descending trend line this morning, and it'll be very interesting to see whether silver and platinum and palladium and all these other precious metals start to confirm gold's prevailing uptrend. Eric, lots to talk about on this uranium move. What are your thoughts?
The reason uranium got absolutely clobbered on Monday is pretty obvious, and that is that a lot of people have perceived the nuclear renaissance to be driven by AI and the need for more power for data centers. So the perception that the AI rally might be in trouble on Monday led to investor sentiment on all things nuclear souring sharply in Monday early trading. But the retracement is already underway to the upside. And frankly, I'm convinced that that weakness was confined to sentiment, not any meaningful change in fundamentals, regardless of what happened with AI. Now look, none of these reactors that are planned in reaction to the AI data center trend have even been built yet, so there is no demand for uranium from that trend yet. Commodity markets aren't forward-looking like the stock market, so there's no rational reason for spot uranium to have sold off anywhere close to as hard as it did. But the fact that it did came as no surprise. Sentiment is sentiment, and this is a volatile sector. I took advantage of the opportunity to add to my longs on the dip, and I'm glad that I did. I won't go so far as to say that the bottom has to be in, but I don't see any negatives on the horizon for uranium itself in terms of any fundamentals in the sector really looking, frankly, it looks incredibly, incredibly bullish. If we get taken down from here, it will be as a result of a broad market risk event or something other than uranium fundamentals itself. And again, the catalyst for that broad market risk event would be a major setback in the Trump administration being able to pursue its policy goals.
To me, I want to split up uranium versus uranium equities, because uranium equities, in my mind, had a lot of that money flowing from the tech spaces and a lot of tech funds buying into this uranium story being an important part of AI data centers and so on. So some distribution in uranium equities makes sense. But I don't think there's any reason why actually uranium itself is going to be impacted in the bigger picture. And so with the selling in these actual uranium funds, like the Sprott Physical Uranium, I think is a buy on dip, because I don't think that there's the fundamental backdrop for physical uranium prices to go much lower. And so I think it's important to differentiate the two. Maybe uranium equities have a little more short-term downside risk based on that sentiment, but I don't think that physical uranium is going to have anywhere near the same kind of volatility as the equities might. Finally, I wanted to just touch on the 10-year Treasury yield. And really, we continue to see yields coming off. And the hawkish Fed statements didn't really create any big reactions. We do have a very important moment on the 10-year yields coming back to test the November highs. If we see this 450 level start to give out and we see yields pressing down towards 4%, then we can define the upper boundary of the trade range that yields have been in for the last almost 2 years, where this 480 to 5% level has really been the ceiling and cap of where the 10-year yields have really peaked out.
Folks, if you enjoy Patrick's chart decks, you can get them every single day of the week with a free trial of Big Picture Trading. The details are on the last pages of the slide deck, or just go to bigpicturetrading.com.
That concludes this edition of MacroVoices. Be sure to tune in each week to hear feature interviews with the brightest minds in finance and macroeconomics. MacroVoices is made possible by sponsorship from BigPictureTrading.com. the Internet's premier source of online education for traders. Please visit bigpicturetrading.com for more information. Please register your free account at MacroVoices.com. Once registered, you'll receive our free weekly Research Roundup email containing links to supporting documents from our featured guests and the very best free financial content our volunteer research team could find on the Internet each week. You'll also gain access to our free listener discussion forums and research library. And the more registered users we have, the more we'll be able to recruit high-profile feature interview guests for future programs. So please register your free account today at MacroVoices.com if you haven't already. You can subscribe to MacroVoices on iTunes to have MacroVoices automatically delivered to your mobile device each week free of charge. You can email questions for the program to mailbag@macrovoices.com, and we'll answer your questions on the air from time to time in our mailbag segment. MacroVoices is presented for informational and entertainment purposes only. The information presented on MacroVoices should not be construed as investment advice. Always consult a licensed investment professional before making investment decisions. The views and opinions expressed on MacroVoices are those of the participants and do not necessarily reflect those of the show's hosts or sponsors. MacroVoices, its producers, sponsors, and hosts Eric Townsend and Patrick Ceresna shall not be liable for losses resulting from investment decisions based on information or viewpoints presented on MacroVoices. MacroVoices is made possible by sponsorship from BigPictureTrading.com and by funding from Fourth Turning Capital Management, LLC. For more information, visit MacroVoices.com.